Hello, everyone. Good morning to you guys. Welcome to another money space. Of course, with me, Kalu. We're here every Sunday, 7 p.m. And of course, we're talking money, the economy, and finance. This week, we're talking the stock market, right? Or we're trying to talk around the market, trying to see if there are any lessons, right, that we can learn from 2025. And look at for 2026 the projections and see what we can basically pick up, right, from last year, and of course plan out for this year, right? So again, I'm going to share like a PowerPoint. I'm going to walk my way through a PowerPoint. So I just shared the YouTube link. If you can follow on the YouTube link, I will also share here on Twitter, so we can just also follow, because it's a lot of visuals, right? I don't want to really talk a lot of numbers and all that. Let's do more with visuals. I think it drives the point home with visuals. So that's what we're going to do today, right? Again, I'm going to take about maybe 20 minutes or so just to run through my slides. Then if you guys have questions, please just request to speak or ask a question. Like I said, I always prefer when you ask, because if I have to read the minutes, I have to like look down and all that. But it's way better if you just request for the mic and just ask a question. Listen, it's a learning season, right? Learning session. So no expertise here. We are all going to learn together. So the topic, of course, is the stock talk, 2025 review, and of course, 2026 projections, right? So let's get straight into our next slide that we have here. I just said the first slide. The guys on the YouTube have a big advantage because they can see, of course, what we're sharing. And then the guys on Twitter, I'm just going to share that slide by slide slides with you. So first things first is going to be our disclaimer, right? So everything we're doing here today is just all educational, right? So I'm not your financial advisor. I'm not offering you, should we say, stock advice or asking you to go buy or sell anything. Just remember that stocks are very risky, and you can lose all your funds, of course, if you invest in stocks. But stocks do beat inflation, so consult your financial advisor before you make any major moves, right? Fantastic. So we've got that out of the way. Let's get into it. This is going to be my next slide. And this next slide, if you look at it, right, what I've tried to do here is to look at asset classes. So we're looking at all the asset classes, and why I like this slide in particular is that we are taking it from 2015 all the way to 2025, quarter four, 2025. And we're looking at basically all the asset classes that you have in the entire world, right? We're looking at emerging markets, we're looking at small caps, growth, equities, REITs, which are that's properties, even commodities. And then this slide is basically showing us that, listen, which asset class did well in 2024, right? Which asset class did well in 2025? Which ones have done well in the prior years? Why this is important, if you look at the chart, you can see they all have different colors. There is not one asset class that is going to be that. If you look at the chart, it's just a potpourri of colors. And what that shows, if Twitter, I've just shared enough for you guys on Twitter. If you look at the charts, from 2015, we had growth that was leading. 2016, small caps were leading. 17, we went back to emerging markets. 18, we went back to global aggregate. Then 19, 20, we went back to growth. 22, we went back to commodities. 23, 24, we went back to growth. 25, emerging markets. Emerging markets was the story of 2025. We'll get into that in the deeper details. And then we ended the year with commodities. What commodities did drove us up? Silver and gold, especially silver. Silver was a rate rally, drove us up. But what's the learning for you from this chart? This chart is basically telling you that you cannot just simply have, should we say, a self-directed passive strategy, right? If you simply look at this and you say, oh, I'm just going to put my money into growth and I'm just going to wait and I'm going to retire in 25 years, you see that growth in 2025 was about way down on the chart here. Look at growth in 2016 was next to last. Growth in 2022 was last. So what it tells you is that you need to have some sort of active but passive structure whereby you are you are in an asset class that is perhaps actively managed, but to you it's kind of passive. So that's what it's showing you here, that listen, you can't really predict the markets. Right now, we saw in 2025 that commodities closed out the year tops. But where was commodities last year? Right? It's way at the bottom. What was commodity in 2024? Way at the bottom. 2023, very bottom. 2015, 2017 at the very bottom. What is commodities we're talking about really is going to be gold and silver. So you can see they were way at the bottom. So imagine if you just had a strategy to say, hey, I'm just going to buy one asset class and that's going to be it. So the key thing here is going to be diversification is very important. So if you are taking down notes, the key thing for us to do in 2026 is going to be really diversification. Not too much. And we're going to show you how to do diversification. That's one key lesson that we learned in 2024 and 2025 and all the past years. You've got to have diversification. You've got to be passive yet active, if that's possible. And we'll try to show you how we think you can accomplish that. Let's now move from the actual market itself, right? And try to look at the, let me see if I can put it here. This is going to be bigger. Thanks. Someone just told me, yeah. So it's bigger now, right? This is way bigger now. Yeah. Let's try to look at the markets now. So we've come from the actual asset classes. Let's try to look at the markets and say which market did the best in 2025 and which markets did the worst in 2025, and try to see also what we can tell from that exercise. Again, if you're on Twitter, I'm just copying it onto literally one tweet. There's a tweet I'm just sharing there. If you just go on that tweet, you just see all the slides there that I'm just sort of replying those slides, that tweet with the slides, and you can just follow. So it's that way you can visually see what we're talking about, right? So if you look at the markets for 2025, which one came out tops? Emerging markets. 2025 was the year, I would say, for emerging markets all across the world. When we mean emerging market, we're talking about markets in, say, Nigeria, markets in Poland, things like that. If you look at the return, the US market is the largest market. And if you know statistics, when you are large, it's harder for you to grow. But the US market has always outperformed even emerging markets. But in 2024, 2025, we saw a shift where emerging market equities, emerging market bonds beat US market, not just by a huge mile, right? If you look at 2025, emerging markets on the average did about 34%. And that was led by South Korea and Japan, right? Japan and South Korea, really from Japan. So you can see Japan, 33%, Asia, 33%, Japan, 25%, even the UK. The UK recovered, after their war with Ukraine, where they had the high inflation. The UK is recovering because those stocks were priced really low. Then, of course, you see Europe as a whole recovering. Then where will we last? At about 17.9%. That's the US. That's US S&P, measured by the US S&P. Where was Nigeria in this? Nigeria beat all these guys. Nigeria delivered about 51%. So Nigeria beat Europe, beat the US, beat every stock market literally that was in the world. Nigeria beat them. Again, what's the lesson here? We've got to diversify our portfolio, right? If you were a Nigerian investor in 2025 and you only invested in Naira stocks, in Nigerian stock market, then you did very well. But what if you did it last year? If you did it last year, of course, the US beat Nigeria. You can see the US 2024 was number one, and emerging markets were about 8%. That's the point again. We can't have this passive strategy forever. We have to have a passive strategy, but a managed passive strategy, whereby you're giving it to experts to say, we don't know when market is going to show up next tomorrow, but we think that if we are nimble enough, we can take advantage of what's going to happen in the market. So that's what you have basically there for 2024, 2025, 2025 especially. The US market did poorly for 5 and for 6. They did very, very poorly for 2025. The big boys were the Asian stocks. Warren Buffett put money in Asia, I think 2023, when he went to Japan and started to buy. And I see, it looks like the market followed him there because the Japanese yen is so cheap that you can do this carry trade and all that. But again, the markets don't lie. They're giving us the numbers, and that's really what we're working with. So that's a lesson again. Diversification, we have to be passive, but we have to be actively managed. That's the story again we're getting from the picture, right? So let's go a bit deeper now. Let's look at the whole market now and sort of see which sector, doesn't matter whether it's stock market, but what particular assets. We've talked about the first one. We said, okay, commodities did well. That's fine. We want to look at which particular asset classes did very, very well on a line basis, right? So we're going to compare, say, the small caps to Bitcoin, and we're going to compare international to silver, and then see if there are any lessons there that we can learn from the performance of these asset classes in 2025. Again, I've shared on Twitter, and the YouTube guys have the advantage to just see it when I move the slides across. So what are we talking about in 2025? Who did the best, the very, very best? You can see it right there, silver. Silver was a late rally. A friend told me to buy silver. I didn't because everyone was looking at gold, and silver just came through with a 141% return. Silver, 141% return. Next, you can see there was platinum, about 125%. Gold had all the noise in 2025, but silver, platinum, boom. A matter of fact, what we termed as commodities, that's basically what's showing up here. Those guys had the bigger return. What else shoots out here? The same thing with copper. Copper, a fantastic return. Look at emerging markets equities, 34%. We've talked about that in the previous slide. That was driven by good like companies in Japan, in South Korea, even Nigeria, because Nigeria did 51%. So Dangote cement is held by many international hedge funds. So they did pretty well there as well. But look at the guys that lagged. Bitcoin, I think this was the worst performing, if you want to call it an asset class, the worst performing asset class in the world in 2025. If you just remove the US dollar is like a currency. But Bitcoin was the worst performing asset class in the whole of 2025. Again, what are the lessons? Last year, Bitcoin was on it, not this year, 2025. Well, I keep on mixing these years. 2025, Bitcoin was on a tear. It went to 126,000 for one Bitcoin. And we see it end the year as the worst performing stock in the world. What really happened to Bitcoin? If you look at Bitcoin is tied to the hip to the NASDAQ. When we say Bitcoin is fiat, it's not connected. But if you really look at Bitcoin and you look at the NASDAQ, Bitcoin and NASDAQ follow each other. And what we call the rotation market, where if investors think that interest rates are high or there's going to be uncertainty, they rotate out of asset classes, right? So it looks like money left Bitcoin and went somewhere else. And because money left Bitcoin, you see it coming down. You also see NASDAQ coming down. NASDAQ is where you have the Alpha, the Meta, Alphabet, Google, all those guys. But they still did poorly because the entire US market as a whole did poorly. So S&P, NASDAQ, and the Dow, they were the worst performers this year. And that sort of rubbed off on Bitcoin. But gold, which doesn't pay any returns, is just a way to park your money. It's essentially where you want to just, you are scared, you know what's going to happen, you put it there. It did pretty well. Why? Again, the tariffs, all the uncertainty around the tariffs that Mr. Trump brought, people were not sure what's going to happen. So they ran to safety. Gold prices went up. Look at silver. Silver has to do with the tariffs again, but from China. Because where do we use silver? Solar panels, right? So China is putting some squeeze on silver, and that's affecting solar panels. That's what we really need it for. So you can see the demand has gone up. Look at copper, again, commodities, things that are for building. There's a lot of infrastructure building across the world, and it's also pulling that down, right? Small caps in the US got decimated. Small caps, mid caps, all decimated. But if you were in an emerging market, like we said, or if you're an international market, you did pretty well, right? So again, just to point out to show you that you've got to have that understanding of global economics and see what's happening. Once Mr. Trump announced the tariffs, it affected the entire balance. The US market had done pretty well. Like we showed you that the US market in the last 2 years, if you look at the US market, right, they are done in the last 2024, they were number one, 2024. 2023, they were number two. 2020, they fell, but 21, they were number one. 19, they were number one. 18, they were number one. 16, they were number two. So they've gone from being a consistent one and two to just crashing, right? And this chart, I think, explains it better how the US really has lost its standing if you look at the total return. So what I've done with this chart is just to pick up, and all these charts again are all from the internet, right? These are the sites that I follow. I just pick them up and I just show that story. So this is from, geez, I didn't get the name of this guy. But if you look at this chart, again, what it's showing you is essentially the return. What I like this chart is showing you the return for 5 years, for 1 month, and of course for the year to date. Now, what I want you to look at is look at the 5-year number, right? And look at the US market, which is that ETF, VTI. The last 5 years, the US has done 13%. No one has come close to the US in terms of returns. So over a 5-year period, the United States equities market has returned about 13% on average, right? Bitcoin has done 18%. So the Bitcoin, just holding Bitcoin alone, has beaten the US stock market. Gold has done about 17%. So just holding gold has been the US market. But the difference is that if you look at the VTI, it's just the consistency of it. Year to date, 17%. 1 year, 17%. 3 years, 22%. 5 years, 13%. If you look across the board, it's hard to find any other asset class with that level of consistency across the board. That is, say, it's beating the market, delivering returns, right? If you look at the NASDAQ itself, if you just went pure technology and you looked at the QQQ, the NASDAQ ETF, that's 15%. The S&P 500, that's 14%, but the average is about 13%, right? Year in, year out. Crude oil prices, again, 5 years is doing 16%, but look across the board, it's red. If you look at it year by year, for 1 month, 1 year, 3 years, it's all red. But because you have spikes in the market, then the market then takes those prices up, right? So again, we've talked about diversification. We're now talking about the consistency of having a position and trying to hold that position. You see, we're saying two things. We're saying don't be passive, but have active management. So you can put your money down on an asset class, but make sure that is professionally managed so that they can rotate out of dead markets for you. So if you just put your money in a particular stock or a particular asset like Bitcoin, then you got burned in 2025, right? But if you were in a professionally managed fund that was rebalancing, perhaps you would have gotten out on an average basis, right? So VTI, even though the stock market in America this year was the worst performer when compared to Nigeria, to emerging markets, to every other market, if you look at them over a 5-year period, they've delivered, right? So it's an amazing market that is so large and delivers so much. Because when you are large, in maths, when the denominator is very, very large, it's very, very difficult to make that denominator change, right? So again, that's one thing that we see that the markets are essentially doing well in the US. So the key thing here is that whatever you want to buy in the world, no matter how you structure your portfolio, always have space in that portfolio for US equities, because they tend to, over time, have this consistent number and they tend to deliver. Again, just to get a bit particular, right, on which markets actually did well. I think we've shared this slide in another way before. International markets outperforming the US market. Number one was South Korea. Again, there's something I want to share with this slide just for a Nigerian audience. So you can see that the number one market was South Korea, that did best. Spain did about 49%. Poland, 47%, right? Greece, Vietnam, even South Africa, 38%. Brazil, 34%. You go down the line, Hong Kong 28%, the US 20%, China, US beat China about 18%, S&P 16%. The key thing here is that if you look at Nigeria, Nigeria did 51%. We don't put Nigeria here because Nigeria's market is so small, right? To be included here in terms of the market cap for these large companies. But it just shows you how underrated the Nigerian market is. And we're going to come specifically to and ask ourselves, is Nigerian market is really underrated? Or is it green shoots or is it astroturf? We have to have that discussion on this space about Nigerian market. But the key thing here is that the Nigerian market on an annual percentage gain is doing better than any stock market listed here, apart from, say, the South Korean market. The South Korean market, the Kospi beats us about 76%. But if we were included here, we'll be number 2. So Spain is just 49. So we'll be between Spain and South Korea. Not too shabby, right, for Nigeria. But again, it shows you the breadth of the market you can invest in. Poland's growth in economy has just been fantastic. They've just gone into this market economy and they are booming. I saw that report where lots of Polish folks that immigrated to the UK are going back to Poland. That's how you know an economy is booming. When your own citizens start to come back home from other countries to essentially come in and grow that economy. So fantastic return there for Poland. I mean, the stock market reflects the economy in a way. If the economy is doing well, it shows up in the stock market. I don't think the stock market goes the other way. I think if the economy is doing well, the stock market must do well. But you can have the stock market doing well and the economy not do well. I don't know if that makes any sense. I think it's always that when the economy is doing well, the stock market does well. But I don't think if the stock market does well, the economy must do well. But that's a topic for another day. All right, so let's go to our next chart. Now let's get into the particulars, right? Most of you are here. But let's get into the particulars and see, okay, let's now look at the Nigerian market. And I've tried to compare the Nigerian market with the US market. We're not comparing. We're just trying to see what stories can we tell from this chart, right? So what I've picked here is to say the pure equity plays in Nigeria. Which ones delivered the best? And what can we tell from those when we compare that to the US market? We already have our answer, right? We said that the Nigerian market outperformed the US market in 2025. So which particular ones, right? We have this now, the funds in the US, in the Nigeria compared to the funds in the US. Again, these are ETFs, mutual funds, where you essentially take your money and give to a manager, and that manager is buying you a basket of commodities. So it's buying maybe you are buying the NGX 30, or you are buying all the stocks in Nigeria just by buying that basket. So it's like passive management, but it's professionally managed, which is what we're talking about. We are passive because we're not participating day to day in run of this fund. We have a manager to do that for us. But that manager is also being active in that he can rebalance, but he's also passive in that he's buying an index or he's buying an asset class and he's staying in that asset class. The number one performing stock in Nigeria was this guy's called Kalu Equity Fund. They delivered 161%. The market did 51%. They did 161%. Massive from them. Future View, 86%. Guaranteed Trust Equity Income Fund, 80%. Zrock Magna did about 64. Stanbic has been one of the oldest, one of the longest guys in Nigeria, professionally managed. They have the largest funds, i.e., in terms of assets under management, about 62%. So they also beat the index. Afri Invest Equity Fund, 53%. They are all SEC registered. They are all good. They might have what they are buying or what they are overweight. That's what's giving them a bit of the extra alpha, extra returns. But the point again is when you buy the Nigerian index, you're doing 51%. These guys are doing way above that. Again, remember, guys, no recommendation, just showing you that if you go through active management, you can still make a lot of alpha if you go through a professional manager. You buy the index, 51% still beats inflation in Nigeria. Even if you use the rebased or the unbased inflation at 51%, is still beat. So yeah, Twitter guys, you'll see what I'm talking about now. Just share that up for you guys. The Nigerian play and the US play. What about the US? Again, I have a liking for Vanguard simply because of the expense ratio. Remember, it's the exact same thing you are doing. Whoever you go to in the US, if you go to Vanguard, Fidelity, Schwab, Invesco, it's the same stocks they're going to buy for you. So what you're watching out for is the expense ratio. What would it cost them to buy you that same stock? So I always have a liking for Vanguard, right? So Vanguard, the top stock market at about 17%, Vanguard 500 about 17.86, slightly higher. The Invesco Nasdaq fund, again, technology, 21%. So again, nothing there is the same story we've seen. The technology is doing better in the US than traditional stocks that are high caps and blue chip. But the Nigerian market is still doing very, very well in terms of returns, 161%. So again, if I had a portfolio and I had Nigeria and I had US, I'm getting the best of both worlds. I get the growth from Nigeria, I get the stability and the value from the US. And again, the US is giving me that consistent 5-year return, 13%. Nigeria has done pretty well. I'm going to see Nigeria's 3-year return, which has done pretty well. But this is a major thing for us that when we want to invest, we've got to look at it globally now. In the past, when I was growing up in Nigeria, it wasn't possible to invest in the US market if you're in Nigeria. It was even hard to invest in the Nigerian stock market. But now in Nigeria, with all these apps that I think you have Bamboo, you have Cowrywise, you have Shaka stocks. You can, in Nigeria, with Naira, buy Tesla, buy Nasdaq, buy all this stuff. So you've got to take advantage. You've got to have a global portfolio. You just can't sit, like I said at the very beginning, you can't just sit passively and not be aware of what's happening around you. We're now plugged into the market. So you could also take advantage of where the market is moving to and then see how you can play in that market, right? Let's do that slide to show US and Nigeria again. This one was showing this is one chart I really want to spend some time on, and I want to ask you guys that question. You guys will come back to me when you want to speak. So the Nigerian market, when I look at Nigerian market and I see the top performers that are in Nigerian market, it's hard for me to explain why they're performing well. So get the point I'm making. I'm not debating their returns. I'm just debating that it's hard to see why that particular stock is doing well. I give you an example. If you look at the American side, what was the best performing stock in America in 2025? It was a company called ScanDisk. It went up 580%. Why did it go up? Memory chip. Remember when we had our trade wars, China is stopping memory chips. So any US based company that is doing memory chips will get tons of sales. So you can tie that back into geopolitics, right? And say, oh, geopolitics with China caused Candice to sell more. So their earnings went up and all that, right? Next was Western Digital. What does Western Digital do? They're in this AI thing. They're in AI. So anything AI in America is attracting capital, attracting monies from the stock market. So they did 282% AI. Fantastic. We can tell that story. It's an AI story. What about next is Micron? Same thing. It's bandwidth memory. It's AI. It's tech. We can tell that story. Seagate, same thing. Robinhood, same thing. That's how you invest in the market. So a lot more Americans are investing, right? And Robinhood is giving them away to invest. They're now doing even for they're doing like IRAs now with Robinhood. So you can look at the stock and tell the story and say, yes, this is what's going up. Google did about 65%. Nvidia did about 38%. You can tell why Alphabet is going up. You can tell why Nvidia is going up. So the US is easy to say, this sector is going to go up. I'm going to invest money in this sector and I'm going to make money. Let's come to Nigeria. The number one stock in Nigeria for 2025 was a company called NCR. They did 1,354% return. That's 1,354% return. But why did they go up in price? We know what they sell, we know what they do, but why 1,354%? Was it like a government contract? The company in Lagos just start buying computers all of a sudden. It's difficult to tell. Then Inusel Interlinked PLC, 781%. Again, why? Then you have an insurance company. Why this insurance company? Why mutual benefits? Why is it doing 552? Why are all the insurance companies not there? Then you have Better Glass. Then you have the Initiates. Then you have Medicare. Then you have Guinness. So why is Guinness here? Nigerian Bridge is not here. Then you have Ella Lakes, you have SCOA, you have Filton Healthcare. So you see, it's lots of sectors in this top 10. There is no, like, if you look at the US side, you can tell it's all tech driven. Not saying it's good or bad. I'm saying you can tell the story better. You can understand it and say, okay, this is a tech story. It's AI, it's tech. Nigeria is difficult. You can't tell NCR is tech. Better Glass is manufacturing. Guinness is fast moving consumer goods. SCOA is assembly of cars. Fitting is healthcare. What's the story? What's the Nigerian to do? Do we invest in everything? Do we pick particular stocks? So you can tell that in Nigeria's case, particular stocks become the flavor of the month. And because at the flavor of the month, people just put money in them, the stock price goes up. So if you're an investor in Nigeria, being passive is a big quote unquote problem because you might be passive and your guys are going to invest in this hot new company called NCR and are going to make 354% return, and you are doing 51% return on the index. Look at America, right? The biggest guy did 580. The whole index is 30%. But we can tell why they did 580. We can tell why Micron AI is doing 282 and the market is doing 28. We can tell because the market itself is not all AI. Magnificent 7 is not the whole market. But Nigeria is difficult for us to tell. So while the US, we can simply say we're going to invest in an index. And even if we invest in QQQ, we're going to track this high-performing AI and tech companies. We can't do the same in Nigeria. Because if we did that, have I shared this with Twitter folks? Ooh, Twitter folks are going to hate me. Let me share this real quick with Twitter folks. I'm so sorry, guys. So it's difficult to tell in Nigeria what to buy. So what's the story for us here in Nigeria? You've got to try to keep your ears to the ground because it's looking more like not a sector play, not an industry play, but a particular stock play where the market just likes mutual benefits or the market just likes Guinness and poof, it goes up through the roof. So I apologize, guys, on Twitter. I just shared you the top 10 both for Nigeria and the US. And again, the story we're trying to talk around is how the stock price move. Because we know how stock prices move, we can know how to invest. We're not talking here by so we're just saying the philosophy of the market in the US looks a bit different. If you did not know anything about stock market, it's easier to invest in the US because you just say AI. So you go to your page and you say AI. It's going to give you, if it's not going to give you ScanDisk, it'll give you something in AI, whether it's going to be NVIDIA or Micron, but it'll give you AI. You can't do the same in Nigeria because we've seen across the board, NCR is the tech company. Better Class is manufacturing. Guinness is fast-moving consumer goods. SCOA, Fitson is healthcare. Where is the sector pool? What's happening in Nigeria? Difficult to tell. Not saying the figures are wrong, but difficult to tell, right? So let's sort of move on. We'll come back to this. I have a chart I want to share with you guys. So now let's do the Nigerian return, right? For the last 3 years. We've seen a US return for the last 3 years. The US return for the last 5 years was about 13%, right? For the last 5 years. What about Nigeria? Nigeria has done pretty well. In 2023, Nigerian stock market, when we say the NGX or ASI, we mean Nigerian stock market all share index. So assuming you bought all the shares in Nigeria, the good ones, the bad ones, everything you bought, your return in 2023 would have been 45%. In 2024, it would have been 38%. In 2025, it would have been 51%. In all these 3 years, you would have beaten inflation. So what's our lesson here? If you are investing in Nigeria and you are worried about inflation, you have to have a portfolio that is a bit into equities. Now, when you get older, be careful because when you invest as you are older, stocks go up and down. So if you're a retiree and you go invest in equities, you might be in trouble. So try to invest in equity if you're a retiree that pays you dividends, not the growth. So for you, the NCR might look good, but be careful, do they pay dividends? Because for you, you can't bank on it going up or coming down. What were the top performing equity shares? I think we shared it in Nigeria before for Nigeria. Future View, this is just pure equity. Pure equity. You can see the returns. Guaranteed Trust Equity Income Fund did 80%. Stanbic, 62%. AfriInvest, 53%. What about balanced funds? I brought this in here, even though we're talking equities, I brought balanced funds in for a reason, because in Nigeria, you've got to also have that balance, right? So we want to do equities because equities are giving us return that beat inflation. But we're also trying to be careful to say, okay, let's sort of balance it out. So balanced funds, they would mix equities and fixed income. So Alpha Morgan did about 67%, FSDH Coral Balance Fund 67%, Quantum Zenith 45%, Stanbic IBTC Balance Fund 49%. So again, you are in that equity exposure, but you are getting that flow of cash, which is balanced. I like that, right? Yeah, guys, I'm going to round up pretty soon. I see already have one speaker, then I'm going to let you guys ask your questions or speak. I'm going to be done pretty soon. Thanks for hanging out with me. Just want to get the slides in so your questions become a bit deeper when you see the numbers presented, right? So the next thing we're going to do, I talked about NCR. I talked about NCR. This is this chart from NCR. So look at this chart with me, right? This was supposed to come in after. So look at this chart with NCR from January. This is the top performing stock in Nigeria, about 1,300 for something percent return, right? Let me get the exact number. So NCR did 1,354%. 1,354%. But look at NCR. They started the entire year all flat, and this is almost for 4 years. Look at it: 1, 2, 3, 5 years. NCR has got a pattern. January, February, March, April, May, June, July, August, nothing happens. But from August or from September, boom, you see that growth there. That growth happened in September, October. Then from say November to December, that's when we got the 1,221% return. So again, you got to ask yourself, what happened in September and October that made the stock go from just having a 100% return to a 1,000% return? What exactly happened? You want to really ask yourself what happened? The graph is really quite steep. Again, it goes back to the point I'm making that in Nigeria, we are moving stocks based on we liking a particular stock. So we like Guinness, or we like NCR, or we like WeCare, and that becomes the flavor, and it moves up in price. It doesn't mean if Guinness is going up, Nigerian products also go up. But in the US, it's hard to see maybe Nvidia going up, and you don't have the other components that make discs or make the RAMs and all that also going up. We showed you the figures for America, where you saw IT as a whole going up. Even when you look at the NASDAQ, which is the index, NASDAQ is doing better than the broad S&P. So tech is doing well. Everything AI seems to be doing well. But it's difficult in Nigeria to also make that story. So if you look at from 2001, again, you see that huge jump there, really going up. Very, very steep graph, which tells you that money came to the market pretty fast, and this stock is a darling. So the numbers are real. There's nothing, we're not saying numbers are not real, but we're just saying you have to have in Nigeria really active management, or you've got to know what is happening. You have to have a broker to tell you what's happening to make money in Nigeria. But the US is you can just put money there in an equity market, maybe VOO, and run away. But Nigeria, you've got to know what's happening. That's the key thing for us to keep in mind. Let's come to this chart, right? This is this is called a rapid transformation chart. I put this chart here to show us how we want to look at investing. Most time when people ask me, what should I buy? I tell them, go to your house, open your fridge, open your garage, look around your house, look at the products you have in your house, write them down, try and get the manufacturer and see if you own shares in that manufacturer. The point I'm trying to make is this, right? Most times, what is a stock? The best predictor of a stock price is its earnings. The best predictor of a stock price is its earnings. So if a stock, i.e. the company, is making a lot of earnings, the stock will go up in price. So if you can get where the earnings are going to be in 2 years, you can predict where the stock would be in 2 years with some certainty. Look at MTN. MTN did very, very well in 2025 in Nigeria. Why? We all know MTN is a good company. We all use, half of the folks on this space today use MTN or Airtel. It's like a duopoly now, right? So Is that enough to say, okay, these are the stocks that went up? Why did MTN go up in price? People say, oh, because there's Forex. No, it's not all that. It's because Nigeria passed, allowed MTN for the first time in nearly 5 years to increase their tariffs. So you saw your phone bill went up, right? MTN. Because your phone bill went up a bit, because MTN was able to recover their cost via the tariff increase, then their profit, the traders then say, oh, earnings are going to go up for MTN, which means their profits are going to go up in MTN. So they bought MTN. That's how it works. Earnings drive stock price growth. So what drives earnings? Breakthrough in technology, breakthrough in markets, new management, anything that can make a company beat its competitor would make that company get earnings. Earnings are not important when you start. What is important is market share. You don't have to be the best product. If you're Nigerian and you're older, you know what we call VHS and Betamax. VHS and Betamax. I'm sorry, the Gen Z guys don't know what we're talking about. But when we were growing up, there was a big competition between VHS and Betamax. And you guys know that Betamax was a better version of for videos than VHS. Betamax was better. Who won the war? VHS. How? VHS got more films because in those days, if you have a film, it's either on Betamax or VHS. But VHS was able to get more films that we want to watch on VHS. So over time, they took market share away from Betamax, and Betamax technology died off. Same with ACDC. Whoever wins the market has earnings in future. So look at this chart. What's this chart saying? This chart is showing you technology and how long it took the technology to basically, let's say, to adoption of the tech. How long did it take the tech to adopt and become dominant? And what is the impact, the capital deepening GDP growth? How do I put it this way? If we have, say, toothpaste, how long did toothpaste stay for the whole world to use toothpaste? And how important was toothpaste to GDP? That's what this chart is showing. So you can see there's no toothpaste here. Why? Because toothpaste is not important to GDP. But what are the things that are important to GDP? Electricity, the steam engine, IT, AI. Look at steam engines. Steam engines took almost 2 centuries from 1760 to 1910 to do what? To adopt. So the steam engine was invented in England. It took a long time before that steam engine got to Lagos. Long time, more than a century before it got to Germany, Asia, but it was transformative. That was industrial age. But it took a long time. And because it took a long time, that's what we really feel that impact. Look at electricity. Yes, it was invented in 1899, and almost rapidly, many countries adopted it, right? But look at its impact on GDP. Not a lot. Because in many villages in Nigeria, there is no power. But Nigeria was the largest economy in Africa. So having power is good if you have a manufacturing facility, but just having power in of itself doesn't guarantee economic growth. Don't misconstrue what I'm saying. In many villages in Nigeria, there's no power, but those villages still contributed a lot to GDP. There are many yam farms in Benue that have no power, but that yams they're producing are adding to our GDP. So you see, electricity is very, very short adoption time, but not a lot in terms of GDP. Same, but look at ICT. ICT is the same as electricity. So a computer, its adoption, if you have a computer in your company or you are IT based or you do stuff with a computer, the impact on the GDP goes high and it takes a very, very short time to get computers in. Computers were 1974. When look at ATM, let's give good examples an ATM machine. An ATM machine, when there was the first ATM machine in Nigeria, again, Gen Z are going to be wondering what I'm saying. So a bank called Societe Generale Bank in Lagos, that was the first ATM in Nigeria. As people go to that bank and look at the ATM. Just look at it. Oh, this thing gives cash. There's no teller, it just gives you cash. So it's years ago. But now, many banks, if you don't have ATM now, you can't survive as a bank. Now we have POS. So you can see the impact of just having an ATM, which is like a computer. Look at AI. You see how AI is shifted to the left, on the left? So what they're telling you here is that AI has a very, very short adoption time and has a high impact on GDP. So what's the point they're giving you as an investor? Anything that AI is going to disrupt, is going to partner, is going to grow, is going to be a world beater, which means the earnings of that company are going to be higher. So if you're an investor, you want to look for anything in and around AI, whether it's the power guys supplying power to AI, or the guys making the chips for AI, or the guys training the folks that are going to be in AI, whatever it is around that AI, that's where we want to be at least in 2026, because they've shown that money drives earnings. Market share drives earnings, and the world today is looking at AI. The top five, should top five stocks in America in 2025 were in one way or the other tied to either AI or tech. Not the same in Nigeria. Nigeria was all over the place, right? So again, if you're trying to invest, you want to basically ask that question: what around AI? Remember, there was when you look for gold in California, Levi jeans, the jean we wear today, was a guy that went to sell tents in California to the gold miners, and nobody would buy his tents. So he then took old tents, washed them, and made jeans. So Levi still participated in the gold rush by selling jeans. Same with you. You don't have to buy AI. There can be a company that makes food for AI workers. That's still AI. But earnings are the best predictor of prices anywhere in the world. So if you can find out a company that's going to make money from AI, that's where you want to put your monies going forward. Subject, of course, to your financial advisor talking to you. Let's look finally, like guys, almost finally. Let's look at our again what did well, just to show you what I'm saying. What did well in America in 2025? Look at this is you guys know Cathy Woods, ARK, 48% return. Arc Space, that's Tesla. Arc Autonomous, or all those guys. Van Beck Semiconductors, blockchain, InvestQ, QQQ. These are all either tech or technology, something to do with that sector of the market. That's why she's doing pretty well, right? Leveraged gold, silver. We've seen that before. So the US market was a commodities market and a tech market. Because of the commodities, why? Because there's all these trade tensions. China is stopping silver from solar panels, so silver is going to go up. But tech is the real story, and you can see the returns there. Cathy was doing negative for long here, now she has turned positive. So AI, there's no company called AI. You've got to go out and find something either supplying power. There's now nuclear power, small nuclear power guys that are being set up today just to supply AI power. The US in a few years is going to run out of captive power to supply the data centers. Who makes data centers? The construction companies that are building data centers are making money. Everything in that environment to do with AI is making money. So you've got to try to plug yourself in. That's how you essentially make money. But if all this is news to you, let's now come back to you and say, how can you play the market? How can you play the market if you don't really know all this? You don't know, you don't want to, you don't, this is too much work for you. I have a strategy I call the Vanguard strategy, right? Why do I? So I have a bias for Vanguard. Vanguard is the largest or one of the largest asset managers in the entire world. And like I've said, if you want to buy Nvidia today, any company can buy Nvidia for you. But why I'm asking you to consider this Vanguard strategy is that you will buy the same stock but at a cheaper price. In this case, you're not going to buy the stock, you are buying the ETF. It can be a mutual fund, it can be a unit trust, it can be an exchange traded fund, but you're going to buy something of that is going to be a basket of that product. And is this on Twitter? I've also shared on YouTube. If you have a pen, you can write it down. This is a very, very easy way for you to invest in the world. So if you want to invest in the world, just look at how this what I've shared. It all starts with V. V just means Vanguard. So let's say I don't know what to buy. I have $100 or I have $500. I don't know what to buy. I don't know anything about investing. What should I get? VT is the Vanguard ETF that captures, they try to capture the quote unquote, if I can use that word, best companies in the world, maybe the best performing or the largest companies in the world. So you have your Nvidia, you have your Samsung, you have your Hyundai, you have your Shell, all those companies globally in the world. That's VT. So you buy VT, you have exposure to stock markets all across the world. VT, very simple. What about VTI? VTI is going to be the same stocks, but only American stocks. So VT is all the stocks in the world. VTI is going to be all the stocks, but just American stocks, about 4,500 American stocks in VTI. So your Nvidia, your Microsoft, your Teslas, all that are going to be in VTI. So what's VOO? VOO is going to be American stocks, but only 500. So VTI is about 4,500. VOO is just going to be those 500. So you see how we're coming down. What's VYM? Same thing, American stocks, but American stocks that pay dividends. So high dividend paying American stocks. So if you're like an older guy, you want to get exposed to stocks in America, but you want dividends. You don't want to you want to get your normal dividends. VYM. This is stocks. When we talk about money market, this is just stocks, not money market, right? So you do VYM. What's VGT? That's technology. You want exposure to just Teslas, the Nvidia, you do VGT, right? VWO, that's emerging markets. You want South Korea, you want Japan, you want China, you do VWO. VNQ, you want real estate. Real estate. That's VNQ. So VXUS is going to be like VTI, but minus US. So it's V minus US. So you're buying your Samsungs, your Taiwan Semiconductor, but you're not buying any US stock. So essentially, you can just, this is like a buffet. Just like a buffet. You can say, I'm going to buy VTI and VYM and build a portfolio. I'm going to put 10% here, 2% here, 3% here, and build out a portfolio. So that way you're building out your portfolio. It's still passively managed. Sorry, it's still actively managed because the Vanguard guys are going to manage this stuff for you. But you are being passive in that you're just going to buy VT and VWO and you're going to go to bed, right? Very, very simple strategy for you to do. And I have it also in my book. I even make it easier for you. So in my book, I did something I call the Rip Van Winkle strategy. And essentially what we're saying is this: if you have to go to sleep for 10 years, how should you structure your portfolio? Because you don't know what's going to happen in 10 years. So if you're going to go to sleep, Rip Van Winkle was this guy that went to sleep for 10 years and woke up and the whole world has changed. So if the same thing happens, if I asked you, hey, you're going to go to sleep for 10 years, what should you buy? How should you structure your portfolio? I want to do it this way. There are only 4 things you should buy, just 4 things. This isn't even easier for you, just 4 things. You buy either the variable side or the fixed income side. So for the variable side, you're going to say, I'm going to buy VTI and VXUS. So you're buying US stocks and non-US stocks. Finish. Same thing with stocks, with fixed income. You're going to buy US bonds and non-US bonds. Finish. 4 stocks, that's it. 4 asset classes, that's it. Your own is now to divide the percentage. If you have 100 naira, do you do 60, 10, 10, 10, or do you do 70, 20? It depends. Normally, if you are older, you do more of bond side. So you do 70 bonds, 30 equity. If you are younger, you do the reverse. You minus 100 from your age, that large number, you do it in equities, right? So it's left to you. These are just the 4 you need. You don't need to go for more than this. VTI, VXUS, BND, BNDX. If you want, you can add the Nigerian one. You can say, oh, I want to do a bit of flavor. I'm going to put Nigerian AGX 30. You can do that. But the point is, with this gives you a passive active strategy whereby you are passively invested with active management in all conceivable stocks that are out there in the market. So it's not to overwhelm you, but it's just in the end, we've come back to this very, very simple thing for you. So we're going to get zero up here to speak. I'm going to call you to speak. And if you have a question, so we're just going to come back. So yeah, so Zero, hi, how you doing? Thanks, guys, for listening. I didn't want to take too long. Jesus, spent a long time, but I needed to get this out. So I'm going to record this, and you guys can basically pull it up again and read later on, of course, if you have. Zero, you've got the floor. Go for it.
Yes, sir. Thank you very much, Mr. Kalu. Thank you. You shared a lot of information this morning. I mean, this information that we pay for to get that you shared with us. I just have a few questions. Honestly, I'm a day trader. I trade a lot. I've been trading for about 5 years now. So I do stock options trading, so whatever the case may be. So that's what I do. But my question circle around the whole issue with Venezuela, oil, Russia, whatever the case may be in that front. from your knowledge, I know that you put out there that you're not a financial advisor. Where do you see WTI, in the near future in terms of, if it's going to rise or if it's going to go down, or if crude oil is going to basically collapse with the influx of more oil coming into the market. So that's kind of the question I wanted to ask you.
And that's a powerful question, because if you understand that the Nigerian budget and all that is tied to whatever we sell in terms of crude oil, then your question is very, very important. So, I mean, if you ask me where WTI, for in our instance, going to be Brent crude, we're going to do Brent crude, where it's going to be, the market has already shown you where it's going to. The market is saying that this is going to be a market with lower prices of crude oil and gas. When we've been going back and forth with Ukraine and Russia, but suddenly there was a time, I think it was last month, I think it was in November, when there was a breakthrough that the Russian government had accepted the Ukrainian proposal, and they were going to come and talk in the White House. Remember that I think it was in November.
Good evening, everyone.
Harry, please hold on. Harry, hold on. So when we had that news, what happened to Brent crude? Brent crude went to 59. Sorry, to 59. It would drop below 60. So the market for crude is only at 60 now. It's 60 now because there's war in Ukraine. Venezuela didn't matter. Venezuela didn't matter to the oil price because they are producing just too little. But what Venezuela does is that China buys oil from Venezuela and blends. So China would buy from Saudi or from the US or from whoever they buy, from Nigeria or Angola. Then they take Saudi oil, which is very, very heavy, and then they blend it to other stuff. What the US is doing with Venezuela is to restrict that. They don't need Venezuelan oil, is to restrict the ability of China to get oil. The same thing the US did to Japan before Second World War. They are cutting off the flow of oil to China. They're doing it in Venezuela. Look at what's happening in Iran. So if you take away Iranian and Venezuelan oil, China's economy really starts to feel the pinch. Where they're going to go to Saudi Arabia, and all the Arab states are all friends of the US, either through Abraham Accord. We call it petrodollars, right? Petrodollars. So to answer your question directly, I think if there's peace in Ukraine, oil prices are going to fall. And are going to fall. Let's look at Brent crude today. Brent crude today is still at, last week it was 60. Our budget is 64. Brent crude today is 61.97. It's gone up 61.97. Our budget is 64. So even now, our budget can't fly. Remember that our budget today is based on us selling 64 barrels at 1.7. The reason why we've had multiple budget failures in the past years was because we are trying to sell oil at 75 at 2 million. So I'm very worried about that we're not really being prudent in the oil price assumption. And we might get to a stage where oil prices crash and we now have a deficit. What happens in the market if we have a deficit zero is that the federal government is going to borrow more. If the federal government borrows more, what happens to interest rates? Interest rates are going to go higher. If interest rates go higher, what happens to the stock market? Stock market is going to go down. That's the problem. That's how you see it's all connected. So that's a great question. And I think it all depends on what happens with Ukraine and Russia. If there's anything like a peace or a detente, oil prices are going to go down. Hope I answered your question.
Yes, you did. Thank you very much.
Fantastic. Let's get to that gentleman. Henry, how you doing? Henry Obi.
I'm okay. Good evening.
How you doing, sir? What's happening?
I'm okay. I'll be very quick. Looking at your returns of assets, I'm seeing Bitcoin. Bitcoin is doing minus 9%. That's for last year. And gold is doing 62%. Then silver 141%. So what I want to know is, where do you see an opportunity here? Because gold has already moved and silver has already moved. So do you think Bitcoin will outperform on a longer term or maybe on a longer run? And also, what do you think about what Michael Saylor is doing with MicroStrategy? Do you think MicroStrategy will keep moving with Bitcoin? Let's say in the next cycle, and if Bitcoin moves up to say previous all-time high, do you think MicroStrategy will keep up or it will keep going down, something like that? So what do you think? Thank you. I just want your view.
Yeah, if you look at the where are the opportunities, we have to go with the market is always a mirror. Market is always a mirror. If the market has gone to 125 before,